Thinking about retiring in Maryland? You better watch this video because we're going to show you how one little rule in the Maryland tax code is going to cost taxpayers a ton of money they were not aware of. And unfortunately, I don't think their financial advisors or even tax folks are aware of it either. And that concerns me greatly. And if they're not aware of it, I imagine you, if you're thinking about retirement in Maryland, are not aware of it either. And we're going to dive into that right now. It's incredible, actually. And I don't know states other than Maryland that has this little rule in there. Now, welcome to the Heritage Wealth Planning YouTube channel, my friends. I appreciate you coming on board here today. And you may or may not be aware, but I do the 50-state guide, state by state by state guide to income taxes or taxes for retirees. Not just income. We talk about taxes, income taxes, sales taxes, and property taxes. And in these individual state analysis, I came up Maryland here is the last one I did. And you'll see I'm wearing my Capitals shirt because, yay, the Capitals won last night. Stanley Cup championships, finally. The Caps, 44 years, never won Stanley Cup. The same day, 40 years ago to the day when the Bullets won with Wes Unseld. Pretty amazing, actually. But anyway, back to taxes in Maryland. So what happens is a lot of people, you look at your state taxes and you say, okay, the state tax is X, Y, Z. That's either bad or good. And I hate to say it, but you got to look deeper into that. You got to look deeper because let's say you have a 6% state tax rate. Well, that might be 6% only on income above $300,000. Or it might be 6%, but you get huge exemptions on income because you're over a certain age. So I'm giving an example. Here in Georgia, and I'm coming to you from North Fulton County, Georgia, we have a pretty significant income tax, state income tax here for the state of Georgia. But once you're over 65, married couple filing jointly, well, I guess each person, each taxpayer unit gets a $65,000 retirement exemption. So essentially, if you're married filing jointly, between you and your spouse, you get $130,000 before you pay one penny to the good folks in Atlanta. But yet, if you don't know that and you just look at the Georgia state income tax rate, you might be misled to think that Georgia has a high income tax. Well, it does, but not if you're retired in Georgia. Absolutely not. In fact, Georgia is actually more favorable than Tennessee, our wonderful neighbor to the north, which has no state income tax. And simply because you got to dive in deeper than just a simple above the top shelf tax rate. So let's talk about Maryland. This is going to boggle your mind. I wonder if I can make this bigger. Well, because it absolutely did me. So Maryland has this saying called the Maryland pension exclusion. Now, first and foremost, let me just be clear. Maryland does not tax Social Security. So Social Security is not taxed in Maryland. Okay, so you got to understand that first and foremost. And like many states, they don't tax Social Security. So Maryland is very favorable there. Even though Maryland is notorious for being a high tax state, they do not tax Social Security. Now, lo and behold, Maryland also doesn't tax a pretty significant amount of other retirement income. And this is called the Maryland pension exemption or exclusion. And here I'm going to read it to you verbatim. If you are 65 or older or totally disabled or your spouse is totally disabled, you may qualify for Maryland's maximum pension exclusion of $29,900 under the conditions described in the Instruction 13 of the Maryland Resident Tax Booklet. If you're eligible, you may be able to subtract some of your taxable pension and retirement annuity income from your federal adjusted gross income. The subtraction applies only if you were 65 or older or totally disabled or your spouse was totally disabled on the last day of the tax year, and you included on your federal return income received as a pension, an annuity, or an endowment from an employee retirement system. In quotes, employee retirement system. Please note, these include defined benefit, i.e. pension, and defined contribution pension plans, 401A, 401K, 403B, 457 plans, Bs. Now, one thing they don't say is TSPs, Thrift Savings Plan, but I'm going to think that's included in here because a TSP is an employee retirement system similar to a 401k. A TSP is a 401k for government employees. And the fact that Maryland has so many government employees working in D.C., I'd be stunned if TSP were not in here. But I looked it up. I could not find it, actually. So I'm going to default and say TSP is included in that. Now, listen, this is critical. Listen. Stop whatever you're doing. Listen. A traditional IRA, a Roth, a SEP, or a Keogh plan, or an ineligible deferred comp plan do not qualify. They didn't say it, but I'm going to say they said a SEP, a simplified employee plan. I'm going to say a simple IRA as well. So if it's an IRA, it does not qualify. 401k, 403b, 401a, 457s, I'm going to throw in TSPs, qualify. IRAs do not. What does that mean? What does that mean? If you roll your 401k over to an IRA and you're going to retire in Maryland, you've just increased or lost the ability to write off $29,900 of income off your Maryland state taxes. And it gets better than that. Here is the spreadsheet they use. It's not just for you, my friends. It's $29,900 for you, $29,900 for your wife. Basically, $60,000 of 401k distributions are tax-free to you, residents of Maryland, on top of your Social Security. But those same distributions, required minimum distributions from IRAs, 100% tax as ordinary income. Required minimum distributions from simplified employee pension plans, SEPs, simple IRAs, Keoghs, deferred comp plans. They don't have RMDs necessarily, but they certainly have distributions. 100% tax to you as ordinary income. We're talking huge taxes here, savings, huge. And just think about it. You're 65 or older. So forget about waiting until you're 70 and a half when RMDs, retired minimum distributions, kick in. When you're 65, you can start pulling money from your 401k as long as it's in a 401k and not have to pay income tax to the state of Maryland. It's insane. Now, there are some specifications. I'll give an example here. If you're qualified, you cannot claim both the standard pension exclusion and the pension exclusion for retirement, law enforcement, fire, rescue, emergency service personnel. So you got to figure out which is better for you. If you're a police officer and you're retired, you can't get that plus the pension exclusion amount. But my friends, if you're going to retire in Maryland, I cannot fathom a reason you would want to roll your defined contribution plan or your annuity or your pension into an IRA. I just don't see it. In fact, I would say if you're thinking about that, you need to stop right now because you got to look at the tax code. I've emailed a couple of CPAs in Maryland. They both agreed with me that, it doesn't make a whole lot of sense. Generally, the rule of thumb is they didn't like rolling plans over to IRAs generally, but simply because there's a lot of times there's more fees if they're hiring a money manager or something like that. But the two CPAs, I don't know who these guys are, just looked at them on LinkedIn. They both agreed that, hey, you got to think twice about doing that for sure. So if you're over the age, if you're going to retire in Maryland and you got money in a 401k, I can't see any reason whatsoever that you'd want to roll that to an IRA. I just don't see it. The amount of money you're going to save on taxes, because don't forget, once you break that threshold in Maryland, you're going to pay a pretty significant tax rate. Watch this. Let's go to the tax foundation. We're going to click on the great state of Maryland here. And once you hit a certain threshold in Maryland, your taxes are high. There's no other way around that. So if we can reduce, look at that. That's just an individual tax rate right there, 5.75. And when you factor in state and localities, you're looking at a pretty significant tax rate of almost 11%. So if you have Social Security and 401k distributions, 403b distributions, pension distributions, you have up to $30,000, $29,900 to be exact, free and clear of income tax in the state of Maryland, and your spouse can have the same. It's crazy. All right, well, I hope this is interesting to you because I found it enlightening. I did not know this. Don't forget to subscribe for more information like this. I'm doing the top. I'm not top 50. I'm doing 50 states, state by state by state by state. I was on Maryland, so I think my next one is Massachusetts, and we'll see what kind of intricacies they have in their tax code as well. But in Maryland, and look at my video. I'll post it right there for how retirees are taxed in Maryland when it comes to income, sales, and property taxes. But if you live in Maryland, you got to think twice or three times before you roll over your 401k to an IRA. All right, let me just real quick. The arguments are there's more investment opportunities in the IRA. That's true. The 401k investment opportunities are fine. Absolutely. Bar none, they're fine. They're institutional shares on mutual funds, so they're usually pretty cheap in terms of fees that you pay. You just get a broad-based index fund, a broad-based international fund if you want some bonds. The investment options in 401ks are fine. It's almost like saying the investment options in the thrift savings plan are poor. You got everything you possibly ask for in the TSP without question. And they're so doggone cheap, they're fine. The only drawback about a 401k relative to an IRA is a lot of times a 401k, you have an inability to have a durable power of attorney. And I don't want to get too deep in this because I've done videos on this. But generally speaking, an IRA gives you a little bit more flexibility to allow someone else to act on your behalf, to actually act as your account if you're incapacitated. You have a stroke, you're in a car crash or something like that. I actually write about that in my book, Strategic Money Planning, 8 Easy Ways to Get Your Financial House in Order. I'm a huge fan of having a durable power of attorney. That way, if you have a stroke or you're incapacitated, you can get your spouse or whoever you want to act on your behalf. But that's not enough to make me say you should pay thousands more in taxes to have a 401k rule to an IRA. No way, no siree, Bob. All right, don't forget to subscribe. Thumbs up are always helpful. Don't forget to, if you put comments in there, I'd love to hear what your thoughts are. And if you have issues on that, if you're a CPA watching this and you think this is crazy that you do taxes for people and they don't pay tax on their IRA in Maryland, please put a comment. I'd love to hear that for sure, because I'm just reading directly from Maryland.gov. I mean, I can't figure out any more legit I could be other than the state of Maryland's own website. If you have a different idea, I'd love to hear it for sure. I'm open. Absolutely. And then, of course, if you do subscribe, hit the little bell for notification down there too, so you can be notified of future content. But we'll look forward to, and then just lastly, my webpage, heritagewealthplanning.com, got my videos, my podcast, everything in there, my blog posts. Go there, heritagewealthplanning.com. But we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.